Welcome back. You're watching us here on Chartbusters. Let's go to the earnings conversation that we have on the show today. Lined up for you, GE Shipping reported a 37% fall in profits. Revenues declined by 20% as well. G Shivakumar, who's the Executive Director and CFO, joins in to discuss more. Mr. Shivakumar, not always fair to discuss these numbers on a quarterly basis because freight rates change regularly. So let's look ahead. Versus where the freight rates were in the first quarter, where do they stand at right now? And what's your outlook on them? If you could give us a sense, what's the current rate and how do they compare with the one that you saw in the first quarter?
Morning, Mangalam. Freight rates currently are at or slightly higher than where they were in the first quarter. For dry bulk, yes, they're a little bit higher. For product tankers, maybe marginally higher. Otherwise, they are more or less similar to marginally higher than in the previous quarter. That is Q1 FY26.
Could you give us absolute numbers? Where do they stand at? And how do they compare with the first quarter?
Yeah, so our product tankers earned somewhere in the $24,000 blended across the different sizes of tankers. They're about the same number, maybe $1,000 more or $500 more. For the crude tankers, we probably average somewhere in the 30-ish region. We are around the same numbers in this quarter. Dry bulk are slightly better. They were probably in the low teens. We're probably somewhere in the $15,000 to $16,000 a day on average.
Okay, all right. Hi, Mr. Shivakumar. Thanks a lot for joining in. Well, with the potential ban on import of Russian crude, that's what various reports indicate. Could it reduce the demand of crude tankers? One of the tailwinds for the last few years has been demand due to long or increased route of Russian crude to India and to China as well. So do you see this as a potential demand disruptor?
Yeah, morning, Nigel. The disruption can happen in more than one way. So you're indeed right. If you just look at if the Russian oil gets removed from the market, then what happens? So one is it can get substituted by, say, Middle Eastern oil, which is the swing producer of oil and which has spare capacity, and which is, yes, a shorter voyage, and therefore has a negative impact on tanker ton miles and therefore on demand. But what's happening at the same time is that a lot of tankers are getting sanctioned. Ships that were carrying Russian oil are getting sanctioned all the time. Just yesterday, we saw 60 ships which are connected with the Iranian trade getting sanctioned. So it's not just the supply that gets taken out, it's also the supply of ships sometimes that gets constrained. But yes, the first impact of a removal of the Russian trade will be a negative for the tanker markets because it will be substituted by, and assuming that can be implemented, it'll be a negative for the market because it'll be negative in ton-mile terms.
All right. Last time, you did speak about looking at buying some vessels, and you've contracted to buy a Kamsarmax, if I pronounce that correct, dry bulk carrier. If you could give us a sense on what price have you agreed to buy it at, and what stage of the cycle are we when it comes to purchase and sale of assets?
Yeah, we don't give details of the price.
Rough estimates?
No, we should rather keep off that. These are confidential with the sellers. This is a second-hand ship. This dry bulk values, especially for the smaller bulk carriers, of which the Kamsarmax is one, are lower in historical terms than tankers. And that's why on a relative basis, they make more sense than tankers currently. What has also happened is that in the last 8 or 9 months, we have sold 2 of our older bulk carriers. We wanted to replace them. I think I've mentioned in the past that we are just, because we are not very happy with the prices currently, and we don't think you'll make a huge amount of huge return on these. We are just focusing on maintaining the capacity. So we switched from the older ships to more modern ships, more fuel-efficient ships. This is one of those transactions where we are replacing the capacity that we sold recently.
All right, so the reversing trend of order book for various categories of ships, from 2017, if I plot a chart all the way till around 2024, appears to have reversed. Now, shipyards, they appear to have a lot more orders in the last year or so. My question to you is, would that be a structural headwind for shipping rates as more supply is expected in the coming years?
Yes, at first glance, it is a headwind because there are new ships being delivered. However, one thing to keep in mind is that even as new ships are delivered, ships are aging out. New energy carbon emission norms can make it difficult for some very old ships to trade as well. So that's something to consider. There are old ships in the fleet as well that are running.
Okay.
But the first impact is that it's negative for shipping because there are ships joining the fleet.
But you're saying that it'll just be a near-term headwind, and then there are some of these ships that are as is obsolete and they're old. So then it matches. It could set off each other in the time to come. Is that correct?
That's the cycle corrects itself by removal of ships. That's the standard way the commodity cycle plays out. Capacity gets removed.
One would have liked for demand to increase as well for the supply to come by, but currently in the global scenario that we're in, that looks like a distinct possibility. So the next few quarters, perhaps not as good. The one thing that is good for you is, the delta that you would get from the renegotiation of rig rates, the offshore rig rates. Could you give us a sense on where you stand at right now and what is the next renegotiation coming up?
Yeah, so we have tied up some contracts for our rigs. Rates have not been great. The market, which was progressing very satisfactorily all the way up to early 2024, got a shock when Saudi Aramco off-hired about 24 rigs within a period of 3 to 4 months. Suspended contracts, technically. And as a result of that, rates have dropped off quite a bit for long-term contracts. The short-term contracts continue to be at pretty decent rates. So there's not going to be a whole amount of upward impact from improvement from rig rates. We currently have 2 rigs, one of which is idling and the other one is earning a very marginal standby rate. So that's not a big positive impact for our results. The vessels business has got repriced significantly higher, and that's contributing a lot to the profitability. The rigs, not so much. We have had 1 3-year also repriced, but at a lower rate than the previous contract. So there is no positive impact coming from the rig repricings currently. And we have all these rigs due for repricing, 3 rigs due for repricing next year.
So what would the normalized
scenario is there?
So once they're repriced, what would the normalized EBITDA run rate for this vertical look like for you from here on?
No numbers. Again, we don't give out projections, but we are not expecting an improvement from our run rate of the last quarter in offshore.
All right, sir. Always a pleasure talking to you. Thanks a lot for joining in here on CNBC TV18. I'll tell you what, with the way things are moving globally, I think we'll have to have a chat in the next month or so. So we request you to please join back and give us an update. For the time being, we take a break, come back, continue our focus on markets.